The American housing market just suffered its biggest monthly collapse in new home sales since 2022, with demand plummeting 13.7% in a single month as buyers completely abandoned the market. Right now, there are 507,000 unsold homes sitting on the market, the highest inventory level since October 2007, just months before the housing market completely imploded. Listen, if you're thinking about buying a home or you're an investor trying to understand what's happening in real estate right now, what we're about to show you is going to fundamentally change how you view this market. The data we've compiled from the Commerce Department, the Census Bureau, and major home builders tells a story that most people aren't talking about yet, but they should be. According to the latest Commerce Department data released just last week, new home sales in May 2025 crashed to a seasonally adjusted annual rate of just 623,000 units. To put that in perspective, during the pandemic boom, we were seeing over 1 million new home sales annually. We've lost more than half of our market demand, and it's accelerating downward. But here's what makes this terrifying. It's not just about the sales numbers. The Census Bureau reports we now have 9.8 months of supply of new homes on the market. In a healthy housing market, you want to see about 5 to 6 months of supply. We're sitting at nearly double that level, and it's the highest we've seen since September 2022 when the market first started cracking. The mortgage rate environment is absolutely crushing buyers right now. According to Freddie Mac, the average 30-year fixed mortgage rate hit 6.77% as of June 26th. That's nearly triple the pandemic lows of around 2.6% we saw in 2021. When you run the numbers on what this means for monthly payments, a buyer purchasing a $400,000 home today pays roughly $1,100 more per month than they would have in 2021. That's an extra $13,200 per year just in mortgage payments. Now, let me show you what's happening to the biggest home builders in America, because their earnings reports are telling us everything we need to know about where this market is headed. D.R. Horton, the nation's largest home builder, just delivered their fourth quarter 2024 results, and the numbers were brutal. According to Reuters, their earnings per share of $3.92 missed estimates of $4.45, and their revenue of $10 billion fell short of the expected $10.2 billion. But here's the really concerning part. D.R. Horton's CEO Paul Romanowski cut their 2025 revenue guidance to just $36 to $37.5 billion, well below analyst estimates of $39.41 billion. They're also expecting to deliver only 90 to 92,000 homes in fiscal 2025, compared to analyst expectations of over 94,000 deliveries. When the largest home builder in America is cutting guidance by that much, you know demand has fallen off a cliff. The stock market reaction tells the whole story. When D.R. Horton announced their results, the S&P Home Building Index plunged 7.8% in a single day, the biggest drop in over 2 years according to Bloomberg. D.R. Horton's stock fell about 8% in pre-market trading, and it pulled down other major builders with it. Lennar and Pulte Group both dropped more than 4% on the same day. Lennar Corporation, the second largest builder, is facing similar challenges, but they're being more aggressive with incentives to move inventory. According to their latest earnings data, Lennar is now spending an average of $47,100 per house sold on incentives. That's over 10% of the sales price. In Texas markets, they're offering $51,600 per house in incentives. And in Florida, the number jumps up to $81,700 per home. These are unprecedented discounts that show just how desperate builders have become to clear inventory. The TD Economics report from their May 2025 housing analysis confirms what we're seeing at the builder level. Housing starts fell 9.8% month over month in May to 1.26 million annualized units, coming in well below market expectations. The decline was driven primarily by multifamily construction, where starts fell 29.7% in a single month. Even more concerning, residential permits retreated for the second consecutive month, falling 2% to 1.39 million annualized units. Now, let me break down what's happening in specific markets, because the regional data shows this isn't just a national trend. It's hitting the markets that drove pandemic growth the hardest. According to Newsweek's analysis of recent market data, sales in the South, which includes major growth markets like Texas and Florida, tumbled 21% in May alone. This region represents the largest portion of America's housing market, so when the South is declining this dramatically, It affects the entire national picture. Tampa, Florida exemplifies what's happening across the Sun Belt. According to Resi Club Analytics, Tampa is leading the national decline, with home prices actually falling 4.5% year over year. Downtown Tampa has experienced a shocking 25% price drop, with median home prices falling to $423,000. The market absorption rate, that's the percentage of available inventory that sells each month, has collapsed to just 30%. Compared to the 3-year average of 48%. This means homes are sitting on the market much longer, and sellers are having to compete aggressively on price. Austin, Texas presents another dramatic example of the reversal we're seeing in pandemic boom markets. New home sales in Austin plummeted 22.5% in April 2025, compared to the previous year, according to local market data. Days on market increased to 78 days, up 19 days year over year. This is a complete flip from the bidding wars and same-day sales we saw just 3 years ago. Austin was supposed to be different, the tech hub that would keep growing indefinitely. But even tech workers can't afford homes when mortgage payments have doubled. Denver's market shows perhaps the most extreme inventory surge among major metros. According to Housing Market Analytics, Denver's housing supply has exploded 64.9% year over year. The city now has 10,345 homes for sale, nearly double their long-term average of 5,181 units. Home prices in Denver have declined 4.1% annually for 15 consecutive months. And here's something really troubling. Net household growth in Denver has actually turned negative at minus 2.1%. That means more people are leaving than moving in, which removes the fundamental demand driver for housing. Phoenix, Arizona, another pandemic darling, is seeing sales decline 10.1% year over year, making it the second worst performing major metro according to national ranking data. Nearly 60% of homes in Phoenix now sell below asking price, compared to the pandemic era when homes routinely sold for 10 to 15% above asking within days of listing. Please take 2 seconds to help us out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now let's continue. The National Association of Home Builders survey data shows builder confidence has plummeted to a 2.5-year low. The share of home builders cutting prices climbed to 37% in June, the highest level since 2022 according to NAHB data. This price-cutting behavior is spreading across all major markets as builders prioritize moving inventory over maintaining margins. But here's what makes this situation different from 2008, and why we need to understand the mechanics of what's happening. This isn't a subprime lending crisis driven by speculation and loose credit standards. The Federal Reserve Bank of St. Louis data shows the median credit score for new mortgage borrowers stands at 772, indicating very high-quality lending standards. Foreclosure activity remains minimal. It actually declined 10% in 2024, according to industry tracking data. Instead, what we're experiencing is what economists call a rate lock-in effect. According to mortgage industry analysis, approximately 83% of current homeowners have mortgage rates below 6%. This makes them extremely reluctant to sell and trade up to current market rates above 6.7%. So even as buyer demand weakens dramatically, housing supply is constrained by homeowners who refuse to give up their low-rate mortgages. The construction industry is also facing unprecedented cost pressures that are making it nearly impossible to build affordable homes. According to NAHB analysis, construction costs now account for 64.4% of the average new home price, the highest share since surveys began in 1998. The industry needs to add 501,000 new workers beyond normal hiring just to meet current demand. But 3/4 of builders report significant labor shortages. This has driven construction wages up 20% in recent years, adding even more to final home costs. The Federal Reserve's latest Senior Loan Officer Opinion Survey shows banks are tightening lending standards across residential real estate categories. This credit tightening compounds affordability challenges for buyers already struggling with high rates and prices. When you combine restricted credit access with doubled mortgage payments, you eliminate the vast majority of potential buyers from the market. From an investment perspective, this creates a fascinating but dangerous environment. The housing shortage in certain areas, estimated at 3.7 million units by Freddie Mac, provides long-term structural support for the industry. Once interest rates normalize and affordability improves, there should be massive pent-up demand from delayed household formation and first-time buyers who've been priced out. But the timeline for that recovery depends entirely on variables outside the housing industry's control. The Mortgage Bankers Association projects rates stabilizing around 6.4% by year-end of 2025. Still well above the 5.5% threshold that research shows most buyers require to enter the market. Consumer sentiment data from the Conference Board shows only 20% of consumers believe it's a good time to buy a home, while 78% of prospective buyers are waiting for rates to fall below 5.5%. For current homeowners, especially those with sub-6% mortgage rates, you effectively own a valuable financial asset that's nearly impossible to replace in today's environment. But that same rate advantage that protects your home value also creates a prison. You can't move or upgrade without taking on dramatically higher monthly payments. Regional markets showing significant inventory increases like Denver and Tampa may offer opportunities for cash buyers or those with exceptional credit profiles. However, timing the bottom in these markets requires understanding that housing cycles typically last 7 to 10 years, and we're only about 3 years into this correction. The bigger picture here is that we're witnessing a fundamental reset of housing market dynamics. Unlike previous corrections driven by speculative excess, this adjustment reflects the collision between normalized interest rates and historical high home prices. For the market to function properly again, we need either significantly lower rates, meaningfully lower prices, or substantially higher incomes. Looking at the data objectively, none of those three variables appear likely to move dramatically in the near term. The Federal Reserve has paused rate cuts due to persistent inflation concerns. Home prices remain sticky due to the rate lock-in effect limiting supply. And wage growth, while positive, isn't keeping pace with the affordability gap created by doubled mortgage payments. What this means practically is that we're likely looking at an extended period of market dysfunction. The Reuters analysis of May's data confirms this, noting that sales of homes where construction has not yet started remain very low, indicating little future support for housing construction. When buyers won't even sign contracts for homes to be built in the future, it signals a complete breakdown in market confidence. The National Association of Homebuilders expects this weakness to continue, with their chief economist Robert Dietz telling Realtor.com that builders will be pulling back on construction in the months ahead due to current inventory levels. Housing permits have already fallen to a 5-year low, which means the construction pipeline for future homes is drying up. For investors and potential buyers, the message is clear. We're in a market where traditional metrics don't apply. The combination of high prices, high rates, and restricted credit access has created an environment where very few people can afford to buy homes, and even fewer are willing to take the financial risk. It's not a temporary correction, it's a structural shift that will likely persist until one of the major economic variables changes dramatically. The bottom line is this. No one is buying new homes because the fundamental economics of home ownership have broken down for the vast majority of Americans. Until mortgage rates fall significantly, home prices adjust meaningfully, or incomes rise substantially, we're looking at a prolonged period where the housing market operates at a fraction of normal activity levels. The data doesn't lie. This is the new reality we're dealing with, and it's unlike anything we've seen since the depths of the 2008 housing crisis. If you found this video interesting, please subscribe, share, and watch this one as well.